What's going on, guys? This is Lior and welcome back to my series on passive investing in real estate projects on this channel, where basically if you're someone that has extra cash or money sitting in something like a 401k and you know you've only invested in stocks and bonds and you want some real estate exposure, but you don't necessarily want to be the main operator, right? You don't want to be the guy executing on projects, buying projects, and doing all that work because you're probably busy making money elsewhere, right? You can invest in other people's deals to get real estate exposure within your investment portfolio. Now, in this specific video, what I'm going to be talking about is doing due diligence on the equity raise. And what I mean by that is with every project, if you're going to be considering investing in someone else's project, they're going to ask you for a certain amount of money, right? And what you want to figure out is what is that money going to be used for? And how does that money align with the proposed business plan, right? Like, is this going to be a major construction project, a ground up, or kind of a light value add? And how does it also align with the financing on the mortgage side that's going to be put in place? So you want to make sure you do your due diligence so the whole story kind of makes sense and kind of wraps neatly together. So with that, let's get into it. What's going on, guys? My name's Lior and I'm a real estate investor out of Boston. Now, before we get into the meat and potatoes of this video, two quick things. If this is your first time on my channel, make sure you smash that subscribe button for me. I put out tons of new videos every single week, ranging from everything about real estate investing to personal finance as it has to do with real estate. I've got series on, being a passive investor like this one. I've got and plenty of more. So if you want more content like this, make sure you smash that subscribe button. And number two, if you want to get my PDF of a recent case study of a BRRRR deal that I did. A BRRRR is a buy, rehab, rent, refinance deal. Make sure you grab that download from the description below. So with that, let's get right into it. And I think it makes sense to start out first by talking about what does an equity raise entail, right? So again, if you're going to be considering investing in someone else's project, what they're going to probably tell you is, hey, you know what? If you're interested, that's great. I'm looking to raise X amount of dollars for this particular real estate deal, right? And this could be $200,000, $500,000, or $5 million, right? But regardless of what that number is, you want to understand how that money or equity is going to be used, right? And I'll give you some of the typical examples of what it's used for, right? Your number one, probably most obvious factor is going to be the down payment, right? So basically the operator, right? The person that's actually going to be executing on the deal is going to be taking some sort of financing on the real estate acquisition or project, right? And typically lenders come in, say anywhere from 65 to 75, maybe 80%. Of the required money, depending on the deal. So the other 20, 25, 30% is going to be cash that's required for the operator to put down. So that's going to be the number one thing that money is used for, is the actual down payment for the bank. Number two thing it's probably going to be used for is closing costs, right? Because just like on the residential side, if you ever bought a single family or condo for yourself, there's closing costs with attorneys, the city, lenders, etc. Same thing on these commercial projects, right? Whether you're buying an apartment building, a ground up project, you're going to have some sort of closing costs. So chances are some of those funds you're going to invest into the project are going to be used for that purpose. Now, other things that the money can be used for really depends on the type of project. If there's going to be some sort of large construction variable, right? Maybe it's like a really heavy value add deal where maybe the investor is going to be like gutting a building or even building ground up, right? There's probably going to be things like holding costs while the renovation's going on, right? So this can entail costs for like insurance and taxes while renovations are going on. It can entail for mortgage costs while renovations are going on. It could also entail soft costs for renovations. So if there's architecture plans that need to be drawn up, or zoning attorney fees, right? Those are things typically not financeable by a bank. So that might be cash that will go, your cash might actually go to pay those bills. Also, depending on how the investor or the operator actually finances the project, If there's construction involved, they might be able to get some sort of construction financing, right? So they'll have an acquisition loan, what's called, and a construction loan. But sometimes a bank may not provide all of it. Maybe they only provide 75% of the required construction funds as well. Maybe they don't just provide the total funds that you need. So some of that money can certainly also be used as hard construction costs, right? Costs directly going to materials and contractor labor. And finally, the other thing that you might see those funds being used for is things like any sort of debt broker fees, or acquisition fees, right? And those are basically fees charged to the investor either by his mortgage broker. An acquisition fee is something the investor will charge you, the limited partner, basically for putting the deal together, right? I can tell you as an operator, it is a lot of work putting these kinds of deals together, between placing the private money, getting the banks involved, having all the legal structure together. It's a crap load of work. And most good operators will charge some sort of fee on the upfront to get paid for all that work they did. Now, having said all of that, once you start to review what those funds are going to be used for, you want to compare them to two things. The first thing you want to compare them is to the type of mortgage and the financing that's going to be used in the deal. And number two thing you're going to want to compare it to is the proposed business plan by the investor. So let's start first by talking about the mortgage side. And on the mortgage side, you're going to want to do your due diligence and actually ask the investor on what kind of financing is going to be brought in place on the deal from the mortgage perspective, right? First of all, as simple as, hey, what % down are we going to need on the acquisition to close on the deal, right? Is this going to be a 20% down payment, 25% down payment, 30, right? What is the actual down payment we're going to need to close on the deal? That should be pretty easy to figure out. The other thing you're going to want to look at is if there's any renovation or construction involved in this sort of in the acquisition or project. You're going to also want to understand, well, how much of the construction or renovation is the bank financing, right? Are they financing any of it, right? Are we planning on using 100% cash to do all the renovations? Are they financing maybe 50%, 75%, 100%? And if they're financing 100%, and you see that there's more construction funds being asked for from you, then maybe you want to inquire and ask and understand, well, why is that, right? I mean, if we're getting 100% of our construction costs financed by the bank, why are you asking for more equity to be used in the renovation fund? Other things you want to look at is, as we talked about, if there's going to be renovations or some sort of value add, there's likely going to be some sort of holding costs, right, while you go through the renovation. So, the project is going to incur fees from taxes, insurance, mortgage payments while you guys do the renovations. So you want to crunch those numbers and make sure they add up to the numbers that are being proposed to you on the raise, right, by the investor, right? Do those numbers add up to what the investor's asking for you to fund? And again, the point of this exercise is not to think that anyone's being devious or anything like that, but you just want to do your due diligence and really understand why and how these funds are going to be used through the project in conjunction with the financing from the bank that's going to be brought in. Now, factor number two that I talked about that you're going to want to evaluate this from is from a business plan proposal, right? So again, you want to really understand what is the plan going into this project, right? Is this going to be a heavy value add? Is this going to be maybe a very light turnover with very little construction? Is this going to be a ground up play? But you want to understand that you want to understand the business plan, and again, match that to what the investor is asking funds for, right? So like we talked about with a bank, if it's a light value add project, right, maybe you're only going to be lipsticking some units, but the investor is asking for $500,000 in capex, right? You want to maybe think about that and ask him, hey, you're telling me this is a light value add, but here you are telling me we want $500,000 for capex on the building. What's the difference, right? Like, what are we missing here, right? So again, you really want to align that strategy going in, right, for the proposed project, and really understand what's going to happen, how the funds are going to be strategically used to fund that business plan. So basically, by really understanding the breakdown of the raise, right, of what the investor is asking you to fund, you can really put that in perspective when you evaluate both the proposed business plan for the project as well as the main mortgage financing, how that's going to be structured, and really make sure everything is turning out apples to apples, right? If you have a heavy renovation project, you want to make sure the financing in place makes sense for that, and you want to make sure that whatever the investor's asking for you to pitch in will fund that kind of plan. Whereas if it's not a heavy renovation plan, if maybe it's a completely turnkey apartment building, again, if there's funds that are going to be used for construction or some sort of holding costs, you want to make sure you understand why that's happening and how those funds are going to be used. So this is a really critical component of due diligence. Again, even though you're going to be a limited partner or a capital partner or whatever term you want to use, you want to really understand the financials and the business strategy behind this investment that you're going to make into, right? Because real estate is like any other business, right? There's a financing component to it and there's a business plan component to it, and you want to make sure those two things gel together real neat. So hopefully that makes sense, guys. If you guys have any questions, just make sure to shoot them below.